is a financial plan? A financial plan is a document that covers an individual's current financial situation, short-term and long-term economic goals, and an in-depth strategy to achieve the goals. A long-term financial plan involves forecasting the financing requirements of a business 3 to 5 years down the road. On the other hand, the short-term financial plan involves forecasting the financing requirements of a business within a year or less, and as is expected, is more detailed than the former. Basically, developing the long-term plan comes down to a few simple steps. So first, we have the forecasting your sales. Forecasted sales may increase based on the target increase in market share or due to the increase of the market itself. Next, we have compute the dividend payout ratio and the plowback ratio. The plowback ratio and dividend payout ratio are two important financial metrics that help investors understand how a company manages its earnings. Number 3, we have identify your spontaneously generated funds. Arise naturally from business operations like increased accounts payable and receivables without needing external financing. The fourth one, use the percent of sales approach to prepare the pro forma financial statement. This sales figure can be based on the latest available financial statement, the average figure the past few years, or a combination of both. The last but not the least, calculate your external financing need. The required additional financing through the additional issuance of interest-bearing debt and common stock to acquire the needed assets. We have here an example. Let us say sales are forecasted to grow 20% next year. Obviously, this translates to a 20% growth in assets. Then, use the percent of sales approach to calculate the weights needed in preparing the pro forma income statement. As you can see, costs and net income were 55% and 31.50% of sales, respectively. Furthermore, the dividend payout ratio is 0%. To prepare the pro forma income statement, simply increase sales by 20%. Then, multiply the resulting figure by 55% to get the costs. To get the addition to retained earnings, simply subtract dividends paid from net income. As you can see from the balance sheet below, your spontaneously generated funds are accounts payables and accrued expenses. The capital intensity ratio is 3, which means that it takes 3 pesos to generate a peso of sales, just like what we did earlier. We use the percent of sales approach to calculate the weights needed to prepare the pro forma balance sheet. As we have computed, cash and accounts receivables are 16% and 44% of sales, respectively. While on the liability side, accounts payable and accrued expenses are 30% and 10% of sales, respectively. Now, we are ready to prepare the pro forma balance sheet. Simply multiply the weights by the projected sales figure. Cash increased to 1,779,516.48, which is computed by multiplying 16% by 11,121,978. Note that cash still accounts for 16% of the projected sales figure. We apply the same process to accounts receivable, inventory, and PPE net. Summing them up, we get 33,365,934, which marks a 20% increase from the initial total asset figure of 27,804,945 and matches the projected increase in sales. On the liabilities and equity side, we just retain the initial figures of all the other line items except for the spontaneously generated funds, accounts payables, and accrued expenses, and the retained earnings. To get the new figures for accounts payables and accrued expenses, just multiply the respective weights by the projected sales figure. In reference to the new figure for retained earnings, simply add the pro forma net income. Since dividend payout ratio is 0% to the initial retained earnings. To complete the process, add total liabilities to total owner's equity. As we can see, these amounts to 32,049,833. This figure is what is known as external financing needed, or EFN. This example is less than the projected total asset figure, which means the business needs an additional financing of 1,316,101. These 1,316,101 can come in the form of additional borrowings or additional capital infusion. A negative EFN, on the other hand, means that the business will have extra funds.